Hello and welcome to Market Domination, sponsored by Tasty Trade. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
In the US, I would say inflation is sticky because the economy is strong. It's very likely that next year, at some point, the Fed will say, hey, we've cut a lot and now we need to pause. And no one is prepared for that. And I think that central banks are right to worry and to push back against this. And probably we've got too many cuts expected, not so much for this year.
I think the bond market is kind of crying out for a 50 cut, and I think that might be wishful thinking. I think that when you're starting at a Fed funds of 5.25, starting at a 25 basis point cut really doesn't do a whole lot.
The tech trade is long in the tooth. I think it's been going on a long time, and I think tech has had a long move, and I think it's not quite over yet, but I think it's pretty much over. And I would be really, really cautious on tech at this point.
We got 1 hour to go until the market close, so let's take a look at the major averages here. We do have the rally continuing today, but with at different paces, I guess you could say. The Dow is up 150 points, good for a gain of about 1/3 of 1%. The S&P 500 up 2/3 of 1%. It's the fourth straight day that the S&P has gained about 3% over that period of time. And then the Nasdaq is up about 1% as well. So continuing to lead gains. Just a couple of other quick notes on that. You might notice the Nasdaq is up 1%. The Russell 2000 also doing quite well today, up about 1.33%. But the equal weight index is up just 1/3%. What that tells me is just another way of emphasizing that tech is sort of probably in the driver's seat today.
You know, one other wrinkle I thought was kind of interesting was Nick Timrose over at the Journal. When Nick reports and writes, people pay attention. I thought it was interesting because obviously next week with the Fed, we've been talking about, is it going to be the 25? Could be a supersized 50? And Nick was saying, could be a close call. I mean, kind of wonder what kind of...
Really? The market doesn't seem to think it's a close call anymore.
So that was another interesting wrinkle today's trade.
Yeah, and here's just a look at the 10-year as we watch that. I mean, the odds of a 50 basis point cuts have dropped
for sure,
way down. Yep. We had PPI today, of course, as well, and producer prices, wholesale inflation coming in sort of similar to what we saw from CPI, in line on the overall number, a little bit hot on the core number.
Yeah, they came in a bit hotter than consensus. It was interesting, though, Julia, to hear economists kind of crunch the numbers and saying the components that actually feed into the PCE deflator were mostly benign, in their words.
Yeah, so not causing a lot of waves. But let's drill down a little bit into what we're seeing in today's session. On the sector level here, you have mostly in the green. Communication services is leading today. That is a group that is tech heavy, but it also includes Warner Brothers Discovery, which is up. We're going to discuss what's going on there a little bit later. You've got tech, you've got consumer discretionary. And if you look at the Nasdaq, just another way, of course, of measuring what we're seeing in tech, all of the Magnificent Seven are up today, and in some cases up by quite a bit. NVIDIA continuing its rally, 2.8%. Meta up 2.7%. Alphabet up 2%. Broadcom has been a standout today, up about 4.5%.
NVIDIA is so interesting. NVIDIA yesterday, that big turnaround, led the charge. It surged like 8% yesterday.
Yeah, you can tap on it. Don't be shy.
I don't want to mess with this whole thing. 3% today. I like how the analyst Peter Bukvar put it. He said to his clients this morning, the AI tech trade will not go down without a fight.
Yes, and here's the fight. This is the 2-day chart here.
Nice point.
That's why I'm here for. That's why I'm here. I'm here.
And thank
you
goodness
say it.
You are.
I put it up here.
I'm just a pretty face, Julie. That's all I am. All right, markets relatively flat heading into the close today. This coming after yesterday's market whiplash that saw the Dow down 700 points before closing in the green. For more on the latest market action, I want to bring in Amy Kong, partner at Corey. And Amy, maybe we'll begin with that economic data today. You know, we got PPI, Amy. We got jobless claims. Just interested in your bigger picture on the U.S. economy, Amy. Where you think we are and where we're headed.
Yeah, Josh, thank you for having me, and Julie, thanks for having me as well. I think, the economy continues to hum along. We are certainly at a point where the surge of purchases, whether it's services or goods, catching up from 3 years of lockdown is well behind us. And so going forward, we are starting to see that the consumer is moderating. We are starting to see, just the general breadth of the market, health of the market is moderating. We're seeing those cracks in the labor market as well. I'm not necessarily calling a recession, but certainly we are seeing a healthy moderation. And I think it's all normal with regards to, again, what we've seen over the past couple of years post-COVID. And now it's just a normalization of some of those trends.
So when you just heard Josh talking about that Nick Timmeros article where he talks about it's still kind of a toss-up between a quarter point cut and a half a point cut. Do you think that's true, or do you think it's pretty much going to be 25 basis points at this stage?
My personal take is that it would be a 25% cut coming in the next FOMC meeting for a couple of reasons. The data that we've been seeing does not necessarily call for 50 as an initial cut. And at the end of the day, let's zoom out a little bit and think about the up cycle that we saw where the Fed has started with 25 and then ramped up pretty quickly with 50 and 75 basis point hikes. That is, in my opinion, an admitting of they were behind the curve. And now we're at the other end of the spectrum where the Fed is now going to lower rates. I don't necessarily think the Fed is at that point where they're thinking that they're behind the curve, and also thinking about the messaging that we've been hearing over the past several months. It has been pointing more towards a 25 basis point cut as opposed to 50. So again, all those reasons combined together, it makes me feel that a 25 basis point cut to start the cycle makes sense. Of course, the data can dictate whether or not a 50 basis point cut could be in the cards.
If they did the traditional 25, Amy, next week, what would you assume the kind of pace of cuts could look like after that?
It's a great question, and I think it's really data dependent. So as I've mentioned just before, I don't necessarily think the Fed believes they are behind the curve. And so as long as the labor market data points, retail sales, you name it, all of that still suggests that the market is still in an okay position, the Fed is probably not rushing to cut in a 50 basis points increment. And so they probably have a little bit of flexibility to do 25 basis points at a time until, again, the data calls for it.
So, we've all been obsessing over this rate cut, of course, but let's look past it if we can and look to what potentially could be the next catalyst for the market after the rate cut. Is it going to be a refocus on earnings? Is it going to be more attention than refocusing on the election that's coming? What do you think?
Yeah, I think the first couple of rate cuts, whether it's maybe 100 basis points, could be just a normalization of the monetary policy that we are seeing today. The reason why we're at where we are today is because we saw CPI data points, PPI, you name it, at very, very high levels almost a year ago. The environment today does not call for such a restrictive policy. And so after the first 100, let's call it, in terms of interest rate cuts, the question to your point, Julie, is what's the market going to focus on? Is the next 100 going to be a function of, well, the economy is not going to be so sustainable, that's why the Fed's cutting some more? That's a really, really important question. I think earnings continue to be a very good support for the system because that is exactly why the markets are still trading at the valuation levels that we're seeing today. And going into 2025, estimates are still calling for a 15% growth rate in terms of corporate earnings from 24 to 25. And much of that is still coming from the tech companies, Mag 7, some of the AI-driven companies to your earlier comments. And so as long as that continues to be the play, I think market conditions, or rather stock market conditions, continue to be in a favorable place.
What's the risk, Amy, to that outlook for corporate growth and margins?
Absolutely. I think the estimates, as we call it, they're estimates, right? And so as long as they continue to be matched, that's great, but certainly the conditions can soften, and you wouldn't expect anything to be a straight line up. I think there could be some ebbs and flows. There could be more competition to certain, semiconductor plays out there. And so any of these headlines could dampen the outlook for earnings going forward. I think one thing that's also worth mentioning is that the estimates for profit margins continue to be on the elevated side. And that's something that I'm watching quite carefully because I want to make sure that, can companies still raise prices in this kind of environment? We've now gone through 2+ years of raising prices, pulling levers to cut expenses. Are we at a point where we've reached a wall. And that's really important as we're thinking about the expectations for profit margins over the next couple of quarters.
Yeah, and you're in a weird position if you're a bull who wants that to continue, because you don't want to pay more, you don't want to keep paying more, but you want profitability at companies you own to keep going up. So it's a tricky situation. Amy, thank you so much for being here.
Thanks so
Appreciate
much.
it. We want to check on shares of Wells Fargo. They are under pressure, but off earlier lows. The bank making a formal agreement with the Office of the Comptroller of the Currency that identified deficiencies relating to its financial crimes risk management practices and anti-money laundering internal controls. Now, at one point, the shares were down more than 6% when these headlines first started to come out, which was just a short while ago. They've recovered a little bit, but still lower here. I mean, Wells Fargo has been under an investigation of one kind or another for quite a long time.
Yeah, the bank saying working to address a substantial portion of what's required in the formal agreement, committed to completing the work with the same sense of urgency as our other regulatory commitments. You look at the stock this year, Julie, it hasn't done a whole lot. Year to date up about single digits. And what's interesting is the street is just evenly, perfectly divided on what to do with this name at this point.
Yeah, and perhaps not surprising given that this has been something of an overhang. So we'll keep on watching it, see if there are any other developments. We're just getting started here on Yahoo Finance and Market Domination. Coming up, Moderna slashing its research budget in a push to reach profitability amid disappointing vaccine sales. We're going to break down some of Yahoo Finance's top trending tickers coming up. Plus, a much-needed win for Warner Brothers Discovery, the streaming giant renewing its distribution deal with Charter. We'll tell you what this means for subscribers and for the stock. And later, Adobe is going to release its third quarter earnings. That's coming after the bell. We'll have analyst reaction on those latest numbers. Stick with us. You're watching Market Domination.
Now, time for some of today's trending tickers. You can scan the QR below to check out the best and worst performing stocks of the session on Yahoo Finance's trending tickers page. And first up, let's take a look at shares of Moderna. That stock sliding as the company's plans to reduce its R&D spending and scale back its drug pipeline, down about 11% here. Revenue outlook for next year, Julie, not good enough. Misses what the street wanted to see. Also, as for the target to break even, importantly, it sounds like that got pushed out from 2026 to 2028. I did see Michael Yee over Jefferies quoted as asking whether they have enough cash to fund their plans to break even without raising additional equity, saying investors unlikely to believe this until further credibility.
Yeah, I mean, Moderna's in a tight spot here. The company has two products on the market, the COVID vaccine, of course, and an RSV vaccine. And now it effectively is trying to focus more on the other things in the pipeline that have a higher chance of success. So it's getting rid of 5 programs in the pipeline to do that refocus. That development budget, the R&D budget, is going down by about 20%. And the street is not happy with them, to say the least. Another analyst, Manny Furhar, over at Leerink, who has an underperform on the shares, and he says this sort of confirms that. But he also says, quote, R&D reductions are too far out chronologically to be credible from a management team that we think has proven serially unable to project the performance of their business. So basically, he's calling it into question the credibility of even these reduced forecasts here. So you can see why the stock is down 12%. And of course, it's also down year to date.
Company's CFO telling reporters we're still dealing with a market of uncertainty. We hope that will settle out this year, but have to brace ourselves just in case vaccination rates continue to go down.
Yeah. One more stat for you, by the way. The record high for the stock was back in 2021. Of course, amidst the heights of hopes around COVID vaccines. $484 is right around where that high was, and it's trading wide around 60-something today. All right, let's talk about some other movers here. We're watching electric vehicles, specifically in China. Chinese EV makers under some pressure. China is reportedly encouraging its car makers to keep advanced EV tech in the country. They're reportedly taking some measures to make sure that happens here. So effectively, many of these Chinese EV makers are building factories around the world, but China reportedly is trying to figure out ways to keep the tech that they're developing largely in China. Unclear exactly how they're going to do that, but you've got NIO down, Li is down, and Xpeng are all under pressure.
Yeah, this was Bloomberg citing sources, by the way, and what they say is China's Ministry of Commerce held a meeting in July with more than a dozen automakers who were also told they shouldn't make any auto-related investments in India. Car makers wanting to invest in Turkey should first notify the government. And of course, it's all coming as these companies are looking to expand internationally, right? They want to tap in and leverage new markets and new customers, find new areas of business, especially as they know their home market is such red hot competition.
Yeah, and where these rules might particularly come into conflict with where they're trying to expand is, as Bloomberg reported, as you pointed out, an European Commission official recently said, if these companies want to operate here, there maybe has to be a minimum level of what's going into the cars that is produced locally. So is that then going to present an issue for their growth if they're also under pressure from China? The shares of all 3 of these companies, by the way, are down more than 40% year to date.
Wow. All right. Finally, last ticker here, moving in on to AST SpaceMobile. That company announcing the successful launch of its first 5 commercial satellites called Bluebirds. After launch, the Bluebird satellites are planned to offer non-continuous cellular broadband service across the U.S. So this does snap a 2-day rally. This telecom company went public in 21, merged with a SPAC. This week they did launch their first 5 commercial satellites into low Earth orbit. Bloomberg said its satellites are about the size of a 1-bedroom apartment, Julie, that it's among a few firms trying to basically provide broadband cellular connectivity through low orbiting satellites rather than cell towers. Investors have piled into this name. Stocks up more than 300%. Though to your favorite stat, it looks like about 20% of the shares sold short.
Yeah, exactly. So you definitely have had a short squeeze going on this year. I mean, basically, as you said, it came public through a SPAC in 2021. and pretty much did nothing for a long time. And then it started signing some contracts with mostly the large telecom companies. AT&T, T-Mobile, and Verizon all signed contracts to provide wireless service from space to those companies. And that's when you really saw the stock take off. It's still a lot smaller than SpaceX, which is its big competitor. And by the way, SpaceX also had a little bit of news today. There was a spacewalk. So there has been this week a lot of focus on this area of space. And this looks like sort of a sell the news kind of reaction after the big pop that we've seen.
Not a ton of coverage on this street,
Yeah,
which
not
makes sense.
surprising.
Tiny, pint-sized guy. But what there is very positive: 5 buys, 0 holds, 0 sells.
All right, let's talk about another trending ticker on Yahoo Finance, and that is Kroger. Shares of the grocery chain operator jumping on second quarter results, and it's also raising the lower end of its annual sales guidance. Our next guest upgraded the stock to buy from hold on this news. And joining us now is Arun Sundaram. He is CFRA Research Senior Equity Analyst. Arun, thank you so much for being here. So, what do you see here as the path forward for Kroger? Because obviously, besides its core business on which it's raising its forecast today, it also has a big pending acquisition that is perhaps in jeopardy. So how do you sort of frame that and think about what is happening going forward?
Sure. Yeah. Thank you. Yeah. So just we can talk about the core business first. I thought the quarter was really strong. Comparable sales grew 1.2%. That's an acceleration from Q1. Q1 only grew about 0.5%. So sales are trending in the right direction. Sales are still, lagging some of its larger peers like Walmart, Costco, for example. But again, it's trending in the right direction, and we're encouraged by that. We're also encouraged by the fact that Kroger's margins are improving. You saw some pretty strong gross margin expansion this quarter. I think that's where a lot of the upside was, and one of the reasons why the shares are up today. And the reason why margins are expanding is, one, they're selling more of their private label brands, which are typically, have higher margins than selling national brands. They're also seeing some improvements in shrink or theft. That's been a big topic we've talked about the past few years, but shrink is improving, and that's leading to better margins. And I think these are these are levers that Kroger can pull over the next year or so to continue to improving margins. So we do like the fundamental outlook of the story, and that's one of the reasons why we upgraded the shares. Now, regarding the pending merger with Albertsons, we actually believe that there's a greater chance that the deal does not go through. But regardless, we do believe that it's a win-win scenario for Kroger whether or not the deal goes through. If the deal does go through, I think the merger will be immediately accretive to their earnings, and so there's probably upside to earnings estimates if the deal does go through. And if the deal doesn't go through, then I think Kroger could accelerate some share buybacks. They paused share repurchases when they first announced this merger, and now that their balance sheet is strong, their leverage is low, I think they could buy back a good chunk of their shares. So yeah, we do see a win-win scenario whether or not the Albertsons merger goes through.
Why, Arun, are you sort of biased? I'm just curious why you sort of don't think it's going to go through. I mean, is that because you think it seems like the argument Kroger's been making is, hey, this acquisition is going to help us compete a lot better against these giants, the Walmarts, the Amazons, the Costcos. Do you think that's just not going to ultimately be a convincing one?
Yeah, no, I think the FTC is, they have a strong point. One, the FTC is attacking this case from multiple angles. Their strongest case is the whole market consolidation fact. They're really trying to argue that the market definition should be the traditional supermarketers, which in that case would be, Kroger's number one and Albertsons is number two. Obviously, Kroger and Albertsons are trying to broaden that definition to include other retailers in there. But historically, the FTC and the government have, chosen that more narrow definition. And then the FTC is also going after Kroger and Albertsons' divestiture partner, C&S Wholesalers. They're arguing that this divestiture partner doesn't have the expertise or the skills to run a grocery chain of this scale. And there's some substance there because C&S Wholesalers, they're predominantly a food distributor, and they don't really have a large grocery retail business. So there is a risk that these divested stores could at some point fail. And who knows, maybe Kroger and Albertsons, repurchases these stores at some point down the future. And then lastly, the FTC is also, arguing that the merger could harm workers. That's probably, not as strong of a case, but, they are arguing that, this could hurt wages and lead to less competitive wages.
And of course, the scrutiny of this merger also coming around sort of heightened sensitivity around consumer inflation, right? Politically, it is certainly very much in focus. I want to go back to the margin point for Kroger right now. Where is that margin improvement coming from, and what does that tell us about where we are in the sort of pricing cycle as well?
Yeah, great question. Yeah, no, one of the reasons the stock's up today is because of the gross margin expansion. And if you just look at that from a very high level, you could make an assumption that Kroger is raising prices more than their costs, but that's just not what's happening right now. The reason their margins are expanding, the number one reason is, I think, is because of sales mix. They're selling more of their private label brands versus national brands, which just generally, it's a fact that those have higher margins attached to it. They're also seeing some cost savings or productivity savings as they source products, closer to their supply chain, things like that. They're also growing their alternative profit business, things like their retail advertising business. It's called Kroger Precision Marketing. They're trying to grow their advertising business, and obviously advertising has much higher margins attached to it than selling groceries inside of a store. And so as these, especially as these alternative profit streams grow, we'll likely see Kroger's margins expand. And again, that bodes well for the company, and it goes to show you that Kroger can expand margins without just raising prices on groceries.
Arun, always good to see you. Thanks for joining us. Appreciate it.
Thank you.
Meantime, mortgage rates falling to their lowest level since February 2023. Rates falling for more than 0.5% over the last 6 weeks, according to Freddie Mac. But the uphill battle for prospective buyers far from over. Joining us now is Realtor.com chief economist Danielle Hale. Danielle, always good to have you on the show. Looking at Mortgage News Daily here, Danielle, they say the 30-year fixed, they say 6.15. Where do you think it is, Danielle, 6 months from now, 12 months from now? What's the trajectory look like?
I think it's definitely lower. The question is how much lower. I think as the Fed starts to cut rates, widely expected that they'll begin to do that next week, we'll see some additional tailwind for mortgage rates to move lower as interest rates normalize, more broadly speaking. We know that consumers are aware of this trend. In fact, a survey high response of consumers expect mortgage rates to go lower over the next 12 months. And so I think while there's some reason for shoppers to get into the market today to take advantage of the rate drop we've seen so far, there is likely to be greater reason to get into the market as we move into next year and mortgage rates are even lower.
They're not moving much quite yet, Danielle. And something else that is not improving is housing affordability. I was looking at a measure from the Atlanta Fed that looks at this housing affordability issue. And as you can see, it's still pretty low. I mean, even if rates are improving somewhat at the margin here. So, of course, it's not just about rates. It's about pricing. It's about availability. It's about supply, all of that stuff. Is that big picture going to get any better?
Yeah, so I do think the rate picture is going to improve. Prices on the asking side of the ledger have been relatively stable over the last year, but sales prices have continued to move up as we see more expensive homes selling and less expensive homes kind of taking longer to sell in this market environment than we've seen traditionally. So there's a bit of shift going on in what's selling. And that does reflect the challenges that buyers of more affordably priced homes are facing. Another component of that affordability triangle is incomes. And the labor market has been really strong, and that has created a lot of income growth that has helped buyer incomes catch up to these higher prices and be able to finance them at higher mortgage rates. And if that continues, that could be a nice tailwind for buyers as well. But as we know, the labor market is starting to soften. And so that is another potential risk factor as we move into 2025. But on net, I think the labor market is going to continue to grow. We're going to see some income stability, if not the same level of growth as we've seen over the last couple of years. And that will help buyers better navigate still high costs and with a nice mortgage rate tailwind to go alongside that.
Danielle, let's talk politics, which I'm sure you're really excited to talk about with me. But Kamala Harris made some headlines, and it was provocative. It was interesting. This idea of $25,000 tax credit, Danielle, to cover the down payment costs for first-time home buyers. As an economist, walk me through how you're thinking about that. Good idea, bad idea, something in between. What do you think?
I think it's a mixed bag. So we know affordability is a challenge. It's especially the case for potential first-time home buyers who, by definition, don't own a home right now and haven't been able to benefit from the rapid accumulation of equity that homeowners have enjoyed as home prices have gone up. So it does help equalize the playing field for first-time home buyers against potential repeat buyers. At the same time, the big picture in housing is still that we don't have enough homes for sale, and we haven't built enough homes to keep up with population. And so this tax credit juices demand, but does not necessarily help on the supply side unless builders respond to it as well. And I think that's a bit of an open question. But in addition to the tax credit, she's also talked about trying to increase affordable housing construction, and that certainly will help on the supply side. So I think it's helpful, but it's important to take a balanced approach and not just focus on the buy side, but pay attention to the supply side when we're trying to think about the housing market moving forward.
Danielle, great to see you. Thank you.
Absolutely.
Coming up, an electrifying partnership. General Motors and Hyundai are teaming up to collaborate on new vehicles in a bid to trim costs. We're going to break down what this could mean for its competitors. Coming up next.
Oil prices jumping more than 2% on the day, despite a warning over global demand. Inez Ferre is here with the details. Explain for us, Inez.
Yeah, it has been a volatile week day for oil prices. We are seeing, as you just mentioned, crude oil that's up more than 2%. Part of this also has to do with Storm Francine, which was downgraded from a hurricane to a that impacted some 70,000.
I think we're losing Inez's audio, so maybe we'll try and check back in with her later. But in the meantime, let's talk about some calls of the day, shall we?
Why not? How about Mike? Would you like a memory chip maker? Can I interest you in
I
that?
will. We should say our calls of the day are sponsored by Tasty
Oh, very
Treat.
nice. Nicely done. Yes. Micron, analysts at BNP Paribas. They go bold, Julie.
Yes,
they go
they
very
do.
bold. The double downgrade, you know that excites me. You know that is. From outperform to underperform. So forget neutral. They fly right past neutral. We're going right to sell. This is the only analyst, I think, with a sell on this name, by the way. They cut the target to what Bloomberg says is actually a street low. They go to 67. What is the issue? What is all this skepticism, you're asking? Analyst says Micron is going to underperform AI peers through 25. They talk about capacity oversupply of HBM, high bandwidth memory chips, and that's going to mean a faster than expected market correction of those DRAM ASPs, average selling prices. The stock is basically now flat year to date, but the analyst says still risk reward, not good.
You know, this is something that we have talked about periodically when we talk about the chips in the AI cycle, which is that chips historically, semiconductors historically, particularly memory, are a commodity business that move in cycles, sort of boom and bust. Too much supply, not enough supply. The prices fluctuate based on that. And that AI doesn't make the industry necessarily immune from those traditional cycles. So that seems to be what's going on here with this memory. Also, the analysts there saying the current average selling price upcycle is going to peak in the November quarter, which is soon, obviously. And so they say, why didn't we just go to a neutral? Why are we going to an underperform? Why are we skipping right through neutral and going to underperform?
Why?
Because the stock is already down so much, so why not just go neutral? So basically they say, when looking at the history of these types of memory average selling prices and their relationship to the company's tangible book value, they say there is still downside risk here because of what they see as this near-term peak in prices.
You're going to hear from the company very soon, by the way, reporting earnings, Q4 print, hot off the presses, September 25th.
Yes, we will be watching those closely. And then we got to talk about Wolf Research upgrading Roku from pure perform to outperform. Those shares up more than 5.5%. The note highlighting that the sales growth is poised to accelerate here. This is the second upgrade for the stock in a week, by the way. Analyst Peter Supino at Wolf writing that the fundamental risks are falling while its sales growth is poised to accelerate. The stock is down about 19% year to date, so coming in here and saying you should buy it after that decline. The price target at $93 from Supino.
Yeah, it says the company rising focus on monetization supports acceleration, should bury the profitability debate. Stocks multiple they talk about as well, undervalues the company's free cash potential, leadership position. As you said, second upgrade in short order. Stock, as you know, not been working, but obviously someone on the street says, you know what, it's an opportunity.
And you know what who the other upgrade was from Stephen Cahill over at Wells Fargo earlier in the week. You know why he likes Roku?
How come?
The Roku channel.
Yeah.
He says it continues to be a share gainer in TV time, and we see upside as monetization improves.
Why not?
Why not?
All right, moving on. Stevens initiating coverage on Carvana with an overweight rating at price target here of 190, note citing the company's transformation of the used vehicle retail market. This is a very upbeat note.
Yeah.
I mean, you read this note, you start pounding the table. That's the kind of note this is. Right circumstances, they say, right business model, right management team. He does note the stock. This has been a monster.
Yeah.
I mean, we're up more than 160% already this year. He acknowledges that. He says, you know what? I get it. It's not an ideal entry point, but he's also saying, listen, my estimates are above the street. We believe the Carvana has reached an inflection point in the early stages of becoming the U.S. used vehicle category killer.
Oh, darn. I wanted to read that quote.
I was taking that line.
Okay, so I'll tell you what he says they're similar to. Home Depot, Ulta, and Chipotle are what he's likening it to as that category killer.
Wow.
He points out that the company only has 1% market share, so that's one of the other reasons he's optimistic for more upside. He's setting the price target $50 above where it is today, even with that increase at $190 a share. So, a lot of bullishness.
Big bull.
Yeah. Let's talk about automakers as well. General Motors and Hyundai have signed an agreement to explore joint product development, manufacturing, and future clean energy technologies. That team up coming as automakers eye capital efficiency, several of which are adjusting electrification plans amid slowing EV demand. And so this is just one of the many structural challenges that are facing the automotive industry. Our next guest taking a cautious industry view on the sector. Here with more, Wolfe Research Managing Director and Senior Research Analyst Emmanuel Rosner. Emmanuel, it's good to see you. You have switched firms, but you got lots of interesting things to say about autos as always. I do want to get your specific take on that partnership, but first I want to get your big picture take on what the auto industry is experiencing right now. As I just mentioned, we've seen pullback in EV production plans. We've seen various surveys that show people aren't planning to buy EVs or even hybrids in the same numbers. Do you think that the industry is rising to meet that changing challenge?
Yeah, thanks so much for having me. I think there's some real unprecedented structural challenges for the industry right here. Some of them is what you mentioned. Essentially, a lot of these mega trends that were expected are taking significantly longer to play out. We're talking about electrification, autonomous driving, adoption of software. So automakers have been making massive investments into it and are not able to monetize them because it's really taking significantly longer. The price points are too high. But then others are also massive market share shifts. There have been some winners in electrification so far. It's been Tesla and it's been Chinese automakers. Over the last 5 years, the top Western automakers have lost 5 points of global auto share, while the 5 Chinese OEs and Tesla have essentially been winning 7 points. And so they are absolutely eating some of the traditional legacy automakers' lunch because they were able to take advantage of lower cost, nimbleness, speed to market, and come up with a product at the right price point, and in a product that consumers want to have. So this has been tremendous structural challenges, like the return on capital from some of these automakers we cover have been under massive pressure because of large investments and unprofitable product. And we really worry how difficult it will be to change this over. So this partnership announcement is definitely today a step in the right direction. It shows that the automakers acknowledge the problem and that they want to be more efficient, partner up in order to come up with product at a lower investment cost, but the road is going to be very long.
And Emmanuel, let's get to some other names here. Tesla, am I right to say you initiated here, Emmanuel, you're neutral on Tesla? If so, how come, and what do you need to see before moving to a buy?
Yeah, so basically on Tesla, we're reinitiated with a peer performance, which is the equivalent of a neutral here, but also with a positive long trading call into the ramp up into their robo-taxi day, which is coming up on October 10th. So the real thing that keeps us more peer perform rated now is the current valuation. We feel like at current levels, the stock is essentially already embedding good value for a lot of the existing businesses continuing to grow. We actually do think that the autos business fundamentals are plateauing here and will probably reaccelerate both in terms of deliveries, gross margin, earnings. We also want to give them credit for all their other businesses, including energy storage, which we're very excited about. But absent adding any new things to it, like robo-taxi as a business or AI, we feel like the stock is generally fairly valued, around these levels. So we're eagerly waiting for the robo-taxi day, which is on October 10th. Want to hear what are Tesla's plans to actually monetize this? What would be the timeline around that? We're not quite comfortable, adding that to our sum of the part currently. But obviously, if they provide the right amount of information, that could provide some upside to here. In the meantime, we have this tactical, shorter-term, long trading call into it because we believe enthusiasm will rise as we get closer to the event. We also believe the event could serve as a forum for Tesla to unveil their next cheaper consumer vehicle, which is something they've promised to come out with in the first half of 2025, and that could give, continue to give the stock some momentum. So I would say positively inclined, but for now we're looking for higher price target.
Can I just pause you on that one? What are the odds, do you think, that we would get the announcement of that new car at this particular event?
I mean, this is a commitment that they've made. They've spoken about using that event as a way to show where the next cheaper high volume car will be. So I think that the odds are actually pretty high. The question is it possible? What are the odds then of it being ready and rolling out the lines in the first half of 2025, those are probably pretty low. So I think we will likely see a consumer car there. If you remember back in April, Tesla moved away from the Model 2, like the next gen vehicle, said this is no longer the focus. We're focused on robotaxi. But then they specifically said, we are working on a cheaper model version of the existing models, something that will be much more mass market. So we're looking forward to that.
Emmanuel, depending on who's ultimately in the White House, whether it's Trump or whether it's Harris, how do you try to think through, as a financial analyst, how, if at all, that possibly impacts your coverage universe?
Yeah, I think there's a potential for a lot of impact from it. So in the case of a Harris victory, I think this would remain positive for the EV winners. So especially, Tesla, certainly, because the tax incentives on EVs would remain in place, $7,500, tax credit, as well as credit for manufacturing batteries. And Tesla is by far, biggest beneficiary from this. And then some of the suppliers we cover that supply, the EV side of the business, such as Aptiv, for example, would benefit from that as well. In the case of a Trump victory, I think this is where there's a potential risk for much more disruption, because I don't think he will dismantle IRA anymore. He has spoken about it before, but now him and Elon Musk are better friends, I would say, and I think he said that he would probably not do it. So at least that risk is gone. But you could see some potential tariffs on imports of vehicles from outside of the U.S., much higher tariffs that would potentially protect the traditional automakers better from this. So maybe be a positive for like the GM and Fords of this world. But then at the same time, if he revives some tariffs on imports from Mexico, this has the potential to be really disruptive for the automotive supply chain. A lot of suppliers are just making their parts in Mexico, bringing them into the US. And last time Trump tried to do something like this was a real big concern. So I would say Harris, victory probably good for the EV names. I think a Trump victory probably good for the traditional automakers, but potentially really disruptive for the rest of the supply chain.
And then, Emmanuel, just quickly here, I was intrigued by your note that your top picks are not automakers themselves. They are within the sort of component and technology universe. Autoliv, Aptiv, and TE Connectivity. Just briefly, why do you like those the best in the coverage?
We worry that the automakers are past the peak of their earnings. They've benefited from optimal, cyclical condition. Vehicle prices have never been that high, and these things will moderate, and they need to keep having to make massive investments in electric vehicles, and their capital returns as a result are suffering from that. Conversely, the suppliers have sort of reduced a little bit the size of this investment. They can really still benefit from secular trends, and so we think their earnings will continue to grow and potentially reaccelerate together with electric vehicles over the next few years. But we're being very, very selective. Only the suppliers that can really deliver that earnings growth or this free cash flow return to shareholders.
Emmanuel, great to have you on the show. Thanks for joining us.
Thank you.
And coming up, Disney Plus offering a sweet new deal on its streaming platform for a limited time only. Want to know just how much? Find out on the other side of this break.
Shares of Warner Brothers Discovery soaring. It's the top performer in the S&P 500, and the media giant signed a new distribution agreement with Charter. Alexandra Canal is here with the details. So, ending this standoff.
Ending this standoff and this renewed deal with Charter, it's very similar to what we saw between Charter and Disney last year, which really set a precedent when it comes to how these deals will be done moving forward. And the crux of it is the access that Charter customers are going to have when it comes to these various streaming services. Before, these customers had to pay for these services as an add-on. Now they will be included in the cable bundle. That's exactly the case here with Warner Brothers Discovery, with those Charter subs receiving both Max and Discovery Plus for no additional cost. In return, Charter will increase the fees it pays to WBD and these other legacy channels to carry their products. And that's a big deal for a company like Warner Brothers. We saw them take a significant write-down in their linear cable business. It's found itself in a pretty difficult position when it comes to the future of this segment in particular. It's currently in a legal battle with the NBA over the loss of those media rights. It's likely that its TNT network is going to lose the NBA. And coming into this negotiation period, a lot of analysts were really worried that that meant the fees that Charter would be paying to carry TNT would decrease significantly. But according to the Wall Street Journal, those fees are going to remain flat, which is a huge deal and part of the reason why we're seeing those shares up around 10%. David Zaslav, he spoke earlier today on the deal at the Goldman Sachs conference, saying it's a great deal for the company. He added that even though basic cable is declining, it's still a great business for them. But besides just linear, streaming is also very important for a company like WBD. And on the streaming side, Zaslav said at that conference that he expects continued growth when it comes to the Max streaming service. He expects that service to add 6 million subscribers in the current quarter. We saw in August that the company reported an increase of 3.6 million subs. So that's something to watch as Warner Brothers reports third quarter earnings in November. But overall, investors clearly very happy that this Charter agreement went through and we didn't see a significant decline in those fees.
Switching gears, Disney Plus slashing the price of their ad-based plan, $2 a month.
$2 a month.
Do I have to get this plan? Is that what has to happen?
You might have to, because $2 a month for 3 months. And guess what? This price is going to increase on October 17th. So this is for the basic Disney Plus ad-supported plan. We know that those price hikes are coming. So this is a way for Disney to really boost those subscribers here. And they're pushing that now is the time to do it, because we have Inside Out 2. That was the highest grossing animated film of all time. That's hitting the streaming service on September 25th. We also have a new show out, Marvel's Agatha All Along, which is a spinoff of WandaVision coming out. I know a lot of folks are excited about that one. So again, just a way to really get as many subscribers as possible at a time when they're raising prices. Obviously, no one likes it when there's a price increase, but if you have a nice little promo that sweetens that deal
Doesn't
a little
help you
bit.
if you already have it.
Doesn't help you if you already have it. Yes, Julie, that's true.
But I will be watching Agatha.
I knew you were going to be an Agatha fan.
I love Catherine Hahn.
I do
What
too.
can I tell
It's
you?
going to be a big one.
Thank you, Allie.
Thank you.
Appreciate it. OpenAI unveiling its first model with reasoning abilities, and our very own Dan Howley is here with the details. Dan.
That's right, Josh. This is not ChatGPT. It's OpenAI O1. And so it's something that's going to be integrated into ChatGPT as well as their APIs. Basically, this isn't yet meant to be something that can scour the web and provide you information like that. They say this is more for physicists, people who are working in the medical field, coders. And the idea is that it's able to, as they say, reason over answers. It'll take longer to provide a response to you because of that, and then provide you with a likely more correct answer than other models would have. It says it can look over its mistakes, recognize them, and then provide you with the right response. And so in one of the tests, they said it measured similarly to PhD students on benchmarks for physics, chemistry, and biology. They said it also excels at math and coding. In the qualifying exam for the International Mathematics Olympiad, the prior model, GPT-4o, correctly solved 13% of problems. In this one, this is O1, it scored correctly on 83%. And so it's clearly improving in the math side of things. That was something that was shockingly difficult for these models to perform. Some people had criticized earlier models for being able to perform basic math. And so this is an interesting development. They say that this is going to be available in preview. It'll be important, obviously, to see how it works in the real world. They say they're working with the US and the UK AI institutes to make sure that they're following safety and that they're giving them previews of these models, something that's also a big deal when it comes to AI like this. But how this eventually translates into something that's a product or becomes part of products later, I think is important. Microsoft, obviously a huge investor in OpenAI, and what this means for them in their own product line is going to be a must ask for Microsoft itself, if and when they start integrating pieces like this into their product lines.
All right, Dan Howley, thanks a lot. Appreciate it. Well, we're wrapping up today's market domination. Don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime. There's the closing bell on Wall Street, and now it's Market Domination Overtime, sponsored by Tasty Trade. Let's get you up to speed on the action from today's session. So a rally here. The Dow actually was negative for much of the day, but then turned higher in the afternoon and stayed there, finishing near the highs of the session. I can say at the highs of the session, up about 0.5% here, 235 points. The S&P 500 also up about 0.75%, fourth straight day that we have seen that gain for the S&P. And the Nasdaq as well, fourth straight gain, up by 1% on the day. We've been talking about the strength that we have been seeing in technology over the course of the day. I wanted to look at some of the other leaders in the absence of Jared Blickery, who was out. This is one of his favorite, the sort of sentiment indicators that he looks at. And some interesting ones on this list. First up, we have the home builders ETF up as we saw mortgage rates tick down yet again to 6.2%. So that group up by 2.2%. They tend to move on sentiment there. ARK, that is the ARK investment sort of benchmark ETF. Invests in sort of transformative technologies, up 1.7%. Retail up 1.6% as well. So an interesting mix here of what's doing well. Solar, though, falling today about 1.25% after some recent gains. And then as we look at what's going on in large cap tech today, we've been talking about seeing some interesting gains. Just wanted to equal weight it for a moment to show you just how much the breadth of gains in the Nasdaq 100 here. Moderna, of course, falling the most. We talked about that earlier after the company came out with a disappointing sales forecast and also cut its R&D budget. But then we've got the Magnificent Seven that are up quite a bit here today. NVIDIA continuing its run, Meta continuing its run as well. Broadcom, a standout as we saw some action in the chips, up by about 4% today. So really quite a number of large cap tech movers to point to today, Josh.
All right, Julie, markets closing high after PPI data showed more signs of inflation moderating. S&P 500 and Nasdaq both logging a fourth day of straight gains there. For more on the latest market moves, we have Steve Sosnick, Interactive Brokers Chief Strategist. Steve, always great to have you live in studio.
Great to see you, of course, in studio, Josh.
This day, interesting. We had a few different cross currents. So we had the economic data this morning, PPI and some jobless claims. Another one I did want to touch on with you today. We talked about it earlier in the show. Nick Timrose out with a story in the Journal. You read Nick very closely because Nick at this point is he's like a shadow member of the FOMC to me, and that's how smart and well-sourced Nick is. And Nick is talking about next week in this debate. There's going to be 25, there's going to be a 50. And Nick's saying here, new piece, how much is shaping up to be a close call? What do you make of that?
I think it's fascinating because to me, I really think it's close. I don't see why they wouldn't do 25. So I think the fact that he's saying it's a close call puts the odds a little bit greater toward 50, more toward 50 than I would have expected. Mm-hmm. As I'm looking at the numbers, Chairman Powell reminded us at Jackson Hole that we should start focusing on the dual mandate again. Mm-hmm. Stable prices, yes, we've been focused on that for however many years now. Maximum employment, we can kind of put that aside because it was fine. Now we have to start paying attention to it again. Well, the employment numbers are definitely, they're squishy. They're not terrible yet. But when you talk about it, still a 4.2 unemployment rate is not terrible. Also, labor costs went up in the payrolls report, and they went up in the CPI report. So you're still getting, that's not telling me that labor is falling off a cliff. If people are getting paid more, it's not as disastrous as, the labor market, it deserves watching. And also the Fed doesn't like surprises. And so we'd gotten down to we'd gotten to a 50-50, in terms of 50 versus 25. We kind of came back to about 15-20%. The Fed doesn't typically like to surprise markets, but Nick Timrose is a Fed whisperer, so I have to wonder what's up. Also remember, you can get accused of politics if you do too much, this far before the election. So
that's a good point.
There's a lot going on.
Lots to consider. You had wrote a note yesterday where you talked about how the Jensen Huang effect had hit the market with him making some comments at a Goldman Sachs conference indicating that demand was still strong for the company's chips, and that sort of helped salvage big tech in particular. Going into these next several weeks, and we asked another guest to this today as well, after the Fed cuts, however much it cuts, then what? Is the focus just go to the next meeting, or do we refocus on earnings, the election? Kind of, how do you think that balance shifts?
A little bit of all of it, Julie, to some extent. I mean, to me, we still have to get through the other part of the Fed meeting, which is the dot plot. And I think we're so focused on the 25 versus 50 debate, the will they, won't they kind of thing. It's like, it's like a rom-com or something. But the other thing that's out there is the Fed puts out the summary of economic projections. We call it the dot plot because it looks, a bunch of dots on a plot, literally. And the market, remember, has been ahead of the Fed for almost 2 years now. I actually wrote about this in August, that August of 22, we were disappointed at Jackson Hole because they didn't announce a pivot. Meanwhile, they just kept raising rates. So we're going to find out if we actually are going to get 1% or more rate cuts for the end of 24 and 2.5% rate cuts for the end of 25. So that will start another round of Fed debates pretty much within microseconds of the Fed decision. So that's part one. Yes, earnings, of course, you can never escape earnings, and those are always crucially important because bottom line is that's what the stock market hinges upon. And then, of course, the election is there, but I really don't think that's been a huge market factor so far. Certainly been something on the forefront of everybody's mind news-wise, but it hasn't. I don't think we've seen a lot of overt bets in the market outside of a few very specific names and sectors.
And you mentioned the earnings, so new earnings season is almost right here, right? Yep. We're right there. What are your expectations, Steve, for just corporate profit growth?
Well, I don't have independent, I basically just have to take them from what the street says, and they're looking for decent, low single digits, but solid profits over the last quarter. Remember, though, the market, we're pricing in basically double digits on the S&P 500 over next year, which again raises the question of how do we have an economy that's strong enough to deliver double-digit earnings, yet soggy enough to require 2.5% in rate cuts? Now, that is the situation we were in sort of at the beginning of this year where we were looking for 6 to 7 rate cuts. Now we're up to actually 10 if you're 2.5 percentage points. But we were looking for 6 to 7 rate cuts for this year, and yet an economy strong enough to deliver earnings. The economy delivered the earnings, and we didn't really care that the rate cuts didn't come. So I think the market has to adjust. And that also falls into the momentum play, and that goes into the comments I made in the piece yesterday.
I want to talk more about that. Kind of, are we in an uptrend or a downtrend? Because people do seem to be coming in and buying the dip because that has worked for them so consistently. But as you like to say, it works until it doesn't.
That's the problem, Julie.
Yeah.
And I will say that, that's why yesterday's recovery was so staggering. And that's why I pretty much wrote in my notes to you that, Jensen Huang is greater than Jerome Powell as far from a market point of view right now, because everybody was freaking out about how, the higher CPI, and we've pretty much ignored the higher PPI today. So, it's really not about that. At this point, it's really about investors just bargain hunting in their favorite stocks and then momentum trading their favorite stocks. And so you've got this double whammy where every dip becomes a buying opportunity, at least for now. And then every rally becomes a chase the momentum opportunity. And that was writ large yesterday, but even today, where we kind of opened, meh, and then off we went. And the problem is this, as I said, it will work until it stops working, but you don't know when it's going to stop working.
Right.
And I kind of compared it to like the frog in boiling water. When a trend changes in the beginning, you don't really notice it. So whatever's been working for you seems to work, and then it kind of doesn't, and then of course you get caught up in it.
You're dead.
Yeah, hopefully not.
If you're the frog,
hopefully not. If you're the frog, you are.
Yes. All right. I want to pause this conversation because we're just getting some numbers out from Adobe that we want to bring to you. The company reporting third quarter numbers here. Third quarter revenue up 11% to $5.41 billion. Excuse me. That's ahead of estimates. Earnings per share $4.65, which is 12 cents ahead of estimates here. The company's fourth quarter forecast, though, might be causing a little bit of trepidation among investors. Fourth quarter revenue going to be $5.5 to $5.55 billion. It looks like analysts on average have been looking for $5.6 billion. And specifically here, it looks like the forecast is short in its digital experience revenue business. It's a smaller part of their business, as well as the digital media revenue, which is the bulk of the company's business. There, they expect at most $4.12 billion, short of the $4.14 billion that analysts had been estimating, Josh.
Yeah, the company's execs are sounding confident tone here. I mean, you see the CEO, Shantanu Narayan, talking about record Q3 performance, talking about relentless innovation, commitment to delivering value to our customers, talks about groundbreaking advancements in AI across the portfolio, meaning Creative Cloud, Document Cloud, Experience Cloud. The CFO talking about how they delivered a cash flows of over $2 billion, exit the quarter with record RPO, the mass markets they're catalyzing. Obviously Adobe, leader in creative content tools and marketing automation software. I mean, there were questions heading into this print, year to date, the stock had not done much, Julie. There are questions out there about, their exposure to marketing budget pressures. That can be a challenge, obviously, when the economy is, as we were just talking about, cooling.
Yeah, and there were a lot of questions about what AI was going to mean to them. If their customers, a lot of them are graphic design professionals, and they're, now you can go to an AI and get an image. There were a lot of questions, and Adobe was trying to incorporate that, but of course there have been some questions about how that was going to play out. And I want to bring Steve Sosnick back into this conversation because I think that's the part that is sort of interesting here is we know AI is doing something now. It's affected some companies positively, some companies negatively, but there is still a lot of uncertainty about how it's all going to play out.
The problem here is, and this goes back to the love for NVIDIA, because they, Jensen Huang is saying people are, my customer, I can't keep my customers happy, but ultimately, who's keeping the customers happy? Are they being able to monetize this? So right now you've got this gold rush, into AI, but we don't really know that how it's going to play out. We don't know that, are you replacing some of your lowest level employees with much more expensive people to monitor and install the technology? Where's the productivity? We don't know yet. I'm not going to dismiss it, but this is normal where, you get the enthusiasm, but then there's the implementation, and that's a problem. And what we're seeing now with the stock, with Adobe declining 8%, it goes back to something we discussed last time I was here, which is it's necessary to beat your posted EPS number, but it's no longer sufficient. When these stocks are so heavily valued, Adobe came into this with about a 44 PE. You got to hit on all your metrics here. So a little bit of weak guidance, sorry, out you go. And that's that's not necessarily fair, but that's what happens when you've priced these stocks so aggressively.
Yeah, it's interesting too. It's just, as we were making our way through earnings season, you would listen to some of these business software makers, and some of them at least were talking about challenges as you are dealing with an economy that's moderating. That is a pressure for IT budgets, marketing budgets, right?
Well, that's what it comes down to. Is there's a lot of signs of moderation. Right now, my bigger concern right now is that the consumer is getting narrowed out from the bottom. We've seen, you've reported on the dollar stores getting clobbered, and that's kind of a bad sign in the sense that, ultimately, if a large segment of the population, the most vulnerable section of the population is really in trouble, that tends to, sort of have a problem. The problem seeps upwards. Walmart's still doing okay, Target's still doing okay, but this is where you get into the economics of it, and the slowing economy is. Do we need the lower interest rates just to sort of keep the party going? Or do we need the lower interest rates because they're really going to have an economic impact? To some extent, we liked the party that we got when we had zero interest rates, but guess what? We're not getting those no matter what. The question, is where is the neutral rate? And Fed's saying 2.5, and I think it's probably really somewhat higher than that. But so are we going to get to party again? And are we still priced for a party? I don't know. And this is really what we have to wrestle with.
All right, Steve, always great to have you on set, my friend. Good seeing you. Coming up, we're going to dive deeper into Adobe's latest results with Third Bridge analyst Charlie Miner. That is coming up next. Adobe shares under pressure here despite a beat on the top and bottom lines in the third quarter. Revenue guidance, though, for the fourth quarter, that does miss Wall Street's expectations. And for more on Adobe's third quarter results, let's get to Third Bridge analyst Charlie Miner. Charlie, it's good to see you. So Adobe reports that stock is under real pressure here in the after hours. We're down about 7%. Give me your immediate take on the report, Charlie, your reaction.
Yeah, I mean, Steve said it a second ago. It's come in with a pretty premium valuation here. You have to check every box to see that number tick up after hours. I would say it's not great. Obviously, a lowered guidance, revenue, and profitability. Also not a disaster. The stock has run up about 10% over the last month leading up to this. Channel checks actually came in pretty strong here. Partners were excited, especially around AI and the opportunity there. And Josh, what I think is important here, and a reason people are still excited about Adobe and will be moving forward despite this print, is the narrative is shifting on them. Over the last 12 to 18 months, there's been a lot of concern about them being an AI loser to someone like OpenAI, Sora, or to a Microsoft tool. Over the last couple of months, though, more and more people are starting to believe that it's going to be really hard to commercialize one of these new AI-powered disruptor tools, and that Adobe is likely to emerge as the leader in AI in this category. So not a great print, but I think the leadership team is going to come on and still be very optimistic and give us some things to be excited about heading into Q4 and beyond.
So, Charlie, where do you sit in that debate then? It sounds like you do share some confidence that Adobe has a sort of a good enough moat that it's going to be able to retain share from some of those new AI entrants.
Yeah, I mean, of the companies that I cover, no one is getting better AI reviews than Adobe right now. The product is being adopted. It's one of these categories where the use case for generative AI is very tangible. People can go out, you can create images, you can create videos. They put out a demo yesterday of their new video AI model that looks very much like Sora, except you're going to be able to use it within these enterprise workflows. We know where these models were trained, all from items in the public domain. You can use these things safely. I think that they're going to be one of the first enterprise software companies to really feel AI tailwinds. And there's even some speculation that they could come out over the next quarter, two, maybe three, and this is speculation here, that they could actually start to break out the AI revenue that they're generating. No one has done that to this point, and that could certainly be a double-edged sword in terms of then having to deliver on those expectations. But they're one of these companies where it's not super speculative, and I actually expect these AI revenues to be tangible and material in the coming quarter. So fair to say, Julie, for sure.
Charlie, the CEO, Shantanu Narayan, he's sounding a very optimistic, bullish tone here in comments, talking about record Q3 performance, talks about relentless innovation, groundbreaking advancements in AI. I'm curious, Charlie, let's say you were on the conference call and you had the chance to ask Shantanu some questions. What would they be?
Yeah, it's all about the monetization. We know people are going to use these AI tools. When is that going to happen? I mean, they're going to be very confident. Obviously, I'm talking about some of the opportunities here. People are going to be disappointed in this Q4 guidance. There's been some speculation that Q4 could actually be a pretty strong quarter for software. Last year, we saw a back-end loaded 2023 as people sort of emptied out their budgets, and there's some optimism we could see that in 2024. Adobe sort of are clearly not riding that wave at this point. I'd be asking first on the creative tool side, when are you going to start pulling that pricing lever? When are you going to start monetizing more deeply? And then on the digital experience side, they're obviously in this constrained software selling environment. What's the plan as we emerge from this? What partnerships are you forming? What is the pipeline looking like? We want to see momentum heading into 2025, so it's going to make that Q4 print all the more important, especially coming off a disappointing result here.
Charlie, can you contextualize Adobe a little more for us in your universe, right? In your enterprise software universe, because as you mentioned, maybe it's a little bit more of an intuitive case for graphic software to incorporate AI. How are you seeing that play out in your other companies that you cover, especially given the vast investments we are seeing?
Yeah, so what's really different about Adobe is unlike someone like Salesforce, who could potentially look to push people into a new AI price tier that could be $30, $50, $100 more a seat, depending on the use case. What Adobe is going to do is they're going to sell credits. So you can go out and you use, just an example, use 1 credit to create an image. Now we're introducing video. You might spend 5 credits to introduce a video. So there's a lot of excitement about something like that. And it's one of the reasons that it's more tangible to be able to break it out like that, where it might not necessarily be part of a bundle and you can really understand the incremental revenue gains that you're getting from AI. And it's really hard for a Salesforce or a Microsoft to do that. They're going to bundle it. They're going to give you discounts for more seats. Adobe is sort of in this spot where people are going to use it. Going back to that question, though, of how are they going to monetize it? How much are these people going to pay? And a lot of it's going to be about differentiation. Are they differentiated from Canva? Are they better than Figma? Right now, that answer seems to be yes. But how deep is that moat and how quickly can those competitors close the gap? The dark horse is Microsoft for sure here. They have their designer tool and they're sinking more money into AI than anyone. If they decide that this is a priority, that's a reason to ring some sirens here for Adobe. I don't necessarily think this will be a top priority. They're more focused on Excel and PowerPoint and the cloud. But if they do, we'll certainly have to watch out.
Charlie, good to have you on the show. Thanks for helping us think through that report.
Thanks for having me.
Time now for What to Watch. Friday, September 13th, sponsored by Tasty Trade. That's coming. Starting off with Boeing. Boeing workers voting today on a new contract the company hopes is good enough to avert a strike at 2 of its factories. The contract would include a 25% wage hike over 4 years. Polls for the approximately 33,000 union workers are scheduled to close tonight, with a potential strike that could begin after midnight on Friday.
And moving over to the economy, the latest consumer sentiment reading for September is coming out in the morning. Economists forecast that number will tick up to 68.5. Again, would be the second in a row and give us more insight into the overall health of the economy as we look ahead to the Fed's interest rate decision next week.
And we're getting new monthly data for import price index. Total IPI expected to decrease by 0.2% for August. That is compared to July's increase of 0.1%.
And tomorrow, finally, if you couldn't tell by my Friday the 13th is tomorrow. It might be a spooky day for investors, but the S&P 500 will look to extend its winning streak to 5 straight days. And according to Dow Jones market data, the S&P 500 has averaged a gain of 0.33% on Friday the 13th, going back to 1980. What year did Friday the 13th, the movie, come out?
I
don't know the
Good
answer
trivia
to
question.
that. I'm going to have to look that up. All right, that'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's Asking for a Trend. We've got you covered with the next half hour for the latest and greatest market moving stories so you can get ahead of the themes affecting your money. Stay tuned.
1980.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetista, your favorite financial educator. Welcome to Capital Gains World for a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
Hello and welcome to Asking for a Trend. I'm Josh Lipton, and for the next half hour, we're going to be breaking down the trends of today that'll move stocks tomorrow. There is a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. And here are some of the trends we're going to be diving into. The Nasdaq and the S&P 500 extending their rally to 4 days in a row, and it's back-to-back gains for the Dow Industrials. Got a closer look at the market action as tech stocks lead the way, plus a deeper dive into some of the biggest names in the sector and what's driving the stocks. Is it the Fed's looming rate cut or this AI trade? Plus, one industry facing tough times, video games. Microsoft laying off workers, Sony's new PlayStation is getting panned, and one video game maker is facing calls to go private. Top analyst in the sector joins me straight ahead. After a deep slump to start September, the tech-heavy Nasdaq has rebounded somewhat this week, but concerns remain due to the uncertainty surrounding the AI trade and the possibility of a supersized rate cut from the Fed, sitting now at about 30%. Here to help us find value in tech is Brad Erickson, RBC Capital Markets Internet Analyst. Brad, great to have you.
Thanks for having me.
And on
nice
set.
To see you. That's right. That's right.
I wanted to ask you about this kind of big trend that we've been talking about, which is you have these tech companies, and we know, Brad, they're putting a lot of money, a lot of investment in AI. We saw some pushback, I think, in the last earnings season. Some investors are saying, listen, show us the return. Then we were talking off camera about this. I saw Michael Dell, though, on X, saying, you know what, he was kind of comparing where we are now with AI to the early days of the internet. And I think what he was saying was, maybe everybody needs to take a deep breath, that game-changing technologies like AI, they just take a while to play out before they show their true impact. Where are you kind of sitting in this debate?
So I think one way to look at it, anyways, would be that there's applications that have emerged for generative AI and just AI in general that are right in front of us. We can see them today, right? And it's easy stuff like software engineering, efficiencies around that. It's customer support. It's a lot of marketing tools, right? Think of like what Meta and Google are doing. There's some interesting things around online professional services, and then there's sovereign AI, right? Like countries spending money to use and exploit data that they have that no one else has, right? Those are known and those are nice, right? I think the comment you were referencing on earnings, though, is like, that's not enough, right? We're spending almost $200 billion. If you look at like the top 4 or 5 CapEx spenders on AI infrastructure, it's $200 billion, and it's going up next year probably by more than 10%.
Do you think at some point, though, the investors in those companies do start to push back, force them to slow that down?
Absolutely. I think where the tweet you mentioned by Michael Dell is interesting, because I think you invest if you aren't going to push back, right? You have to adopt that view. It's a little blind faith that like, hey, I just can't quite see that far in the future of what this is going to do, but I know it's going to work. And I think, from my perspective, like we're taking a little bit more measured approach, saying, look, $200 billion. Think about what you need to do to maintain operating margins. Pretty simple math of like, are we really talking about like $400 billion of marginal revenue every single year? Those are big numbers.
Yeah. Well, let's talk about some of these big tech companies that are spending a lot in AI investment. You cover Alphabet. You like that name. I think outperform, right? Still Alphabet. There are some, it's interesting, Brad, some of your colleagues on the street, even they have buys, right? But I sense a little, I don't even want to call it concern. They're at least raising questions about what the what does long-term search actually look like with rising competition from names like Sam Altman over at OpenAI?
Sure.
Just how are you thinking about that dynamic?
Yeah, so a lot of time being spent analyzing like, hey, we've heard about Claude, we've heard about Perplexity, we've heard about ChatGPT, what is Gemini going to look like, right? There's all these competing tools. Our view is they're all going to end up looking a lot of, the same kind of thing. Distribution is really what matters, and so now we're talking about Apple. Right. What's going to happen? ChatGPT is apparently going to be integrated with iOS 18, and over the next month we'll see. What is that going to do to Google's distribution? That's kind of the biggest question right now. And I think, if you look at what's happened over in Europe, right? They implemented some of these changes where users have a choice, right? You get a phone, you get onto your browser, you have a choice of what default search engine. Google's going to lose a little bit on that, but not much.
Is it also part of your optimism because you just think also Google's own Gen AI innovations are going to improve the search product too?
Yeah, I think they already have, right? Yeah. Management talks about how they actually drive engagement increases as they've improved that generative AI capability. So it has helped already. But again, the question, I think people focusing on like whose chatbot is better is not the right way to think about it, or doesn't matter as much. It's more distribution, right? Is their distribution going to be impacted from some of these upcoming changes?
Let me ask you another. I was looking across your coverage universe. I have to ask you about Uber and Lyft. I've got to ask you because you're laughing already. I have to ask you because Uber, you have buys on both.
Yes.
But everybody loves Uber. Uber's like the NVIDIA of ride sharing. I mean, everybody loves it, right? Lyft is more interesting because the vast majority of guys on the street, Brad, your colleagues, they're on the sidelines. They got holds, right? But you have a buy on the name. Just explain the thesis to me, Brad.
Well, we like to live a little, as we say. So that's the reason number one. Now, the simple reason is we actually do our own data tracking on this space. And what we detected about, call it about 9 months ago or so, was for 2 years prior to 9 months ago, Uber was consistently showing better in our data. 9 months ago, something changed. The world equalized. And that's not to say market share equalized, but basically that Lyft was keeping up on price and they were keeping up on pickup time. The moment that happened, we put out a note and we said, hey, at the time we were neutral rated, but we said, hey, this is new. This has changed, right? 9 months later, you look at their performance, there's been fits and starts. But generally speaking, we do think we're on that trajectory, and we continued to see it. That's why we upgraded the stock. And expectations are super, super low. So it's like, I don't need them to like throw a football over a mountain to get this thing to work. I just need them to execute a little bit better.
Fair enough. Brad, great to see you. Great to have you in studio.
Thanks for having me.
Thanks for coming. All right, the S&P 500, Nasdaq jumped for 4 straight days. Tech leading stocks higher. For more on the trading day takeaways, let's get to Yahoo Finance's very own Alexandra Canal. Allie.
Hey, Josh, you said it. S&P higher, Nasdaq higher, all coming on the heels of softer inflation, more moderating inflation numbers. We saw earlier today the producer price index coming in line on an annualized basis, 1.7% for the month of August. And then we saw that July number revised down. And this comes one day after we saw consumer prices on a headline annual basis hit 2.5%. That is the lowest that we've seen this number since early 2021. So that's all fueling optimism that the Federal Reserve is going to cut interest rates by the end of their September meeting. However, traders now anticipate just a 25 basis point cut rather than that 50 basis point cut because we still have some very sticky areas of the economy where inflation is just not moving in the direction that many want it to move. What the Fed really wants to see is shelter come down more significantly. We've seen hot month-over-month core readings, so that's all boosting optimism that it's probably going to be 25 basis point. It's not 50, but we have heard from Fed officials that the amount of a cut doesn't really move the needle that much. It's really about the pace of a cut. So that's all lifting the markets.
You can listen to Fed officials.
Yeah.
I also listen to Nick Timiraos over at the Journal.
Yes, he's
right?
great. Yeah.
Okay, and when Nick writes, I pay attention. And I thought it was just interesting with Nick's latest article when he's saying, I mean, you're right to say next week it's all about, is it going to be a traditional 25, you're going to get the supersized 50. Nick is saying it's actually kind of a close call. And I thought that was a really interesting headline that maybe explains some of the market moves we saw today too.
It's also interesting because I feel like over the past year, we've known what the Fed is going to do, right? Likely hold rates steady, hold rates steady. I'm curious if we do see a 50 basis point cut rather than a 25, how will markets react?
Yeah.
Because there's been this thinking that markets actually wouldn't react that well to a 50 basis point cut, but we'll have to see next week.
All right, next takeaway.
All right, next takeaway, commodities corner, because commodities did rally today. I want to take a look at gold prices hitting another record high. We're seeing gold trade just under $2,600 an ounce, and gold year to date has really outperformed here, up more than 25%, outperforming the broader markets. This is obviously ahead of that expected Fed rate cut next week. And then we've seen rising geopolitical tensions as we typically see gold operate as that safe haven asset for a lot of investors. But it wasn't just gold that caught my eye today. I also want to look at crude oil. We saw crude finish the day up just about 3%. Now, this comes as we've seen more crude disruption in the Gulf of Mexico due to Hurricane Francine. Year to date, though, crude is down about 2% at this point as those demand concerns really are continuing to weigh on this market at large. So we'll see where oil prices move in the future. That the fact that we are below $70, that was a technical level that a lot of Wall Street analysts were saying to watch. We'll see where we could see crude over the long term.
Record U.S. production, weak Chinese demand. Yeah,
Yes,
that's been the story.
exactly.
Thank you, Allie. All right, coming up, more layoffs at Microsoft. Tech giant plans on making more cuts to its staffing roster over at Xbox. It's coming up next on Asking for a Trend. Microsoft cutting about 650 jobs from its Xbox gaming division in what's been a tough year for the video game industry. But there is a lot to look forward to, including Sony's PlayStation 5 Pro console and some much anticipated games you might be able to play on it. Here to help us navigate the latest trends in the video game space is Michael Pachter, Managing Director of Equity Research at Wedbush Securities. Michael, always great to see you, my friend. So let's get right to this headline, this report that Microsoft's going to be cutting about 650 jobs in its Xbox unit. I'm curious what you made of that headline, Michael. And then just more broadly, you look at the gaming industry this year. We've seen some significant layoffs. What do you think explains that trend, Michael?
Well, Microsoft's a bit unique because they've been acquisitive. So, they bought Activision last year, and these 650 jobs are primarily redundant corporate positions. And again, I don't mean to discount what these people do, but how many HR people do you need, or legal people, or marketing people? So they're just consolidating the division, the Activision 8,000 or so employee division, into the overall Xbox division. And these are the jobs that they found that had that were duplicated. What's going on in the industry, and we've had many more layoffs. The industry got fat during shelter in place. So in 2020 and 2021. Game revenues went crazy high. It was much like Netflix went high. We were stuck at home and we were entertaining ourselves. And everybody overstaffed, kind of building more content, assuming it would last forever. It came crashing down in 23 and 24. And I think most companies are right sizing. I actually think they're probably cutting too much, and I think they'll regret it. But they're trying to be good stewards of capital and trying to manage their expenses the best they can.
And Michael, when we talk, you always teach me about how the model of the video game industry is changing. Explain that and how that could be impacting these trends as well.
We're seeing maybe for the last 15 years a migration from buying a game, so a paid purchase, 50, 60, 70 bucks, to ongoing in-app purchases. And it's not all or nothing. We still buy games. But you had games like FIFA back in the day or Grand Theft Auto back in the day. The only thing you could do was buy the game. Now you have Ultimate Team that is almost as big as first year sales of the underlying now called EA Sports Football Club game. And you have GTA Online doing $400 or $500 million a year. That keeps people engaged. And when they stay engaged for longer than just a couple of months playing the game, they buy fewer games. So it's kind of a self-fulfilling vicious cycle where you buy fewer new titles and you play the ones that you purchase much longer, which means you make fewer games, yet you make a lot more money. We saw that with the movie industry. It's happening in the games industry. At the same time, you got Microsoft, rolling out a subscription service. We'll see if that works, but they're certainly buying up a lot of content in order to support it. And I think they're serious about making it into a giant business. So ultimately, I think that succeeds and also replaces new game sales.
I want to go on a different topic, Michael. Get your thoughts on this new Sony console, what they're trying to achieve with this console, Michael, and whether it shows us, whether it suggests really that Sony's kind of doubling down on consoles here.
Yeah, that's exactly the right term, Josh, doubling down. Microsoft and Sony are two very different companies. Microsoft, I think, their vision of the future is that consoles are going to ultimately just be a specialist purchase. It's going to be a super fanboy purchase, and most people are going to get their games from the cloud, so they're heading that way. Sony, I think, is hanging on and managing its future strategy by looking in the rearview mirror of what got them there, and they're embracing consoles now and forever. So, of course, the $549 PlayStation 5, which is not really selling that well, isn't enough. Let's offer a $700 PS5 Pro that doesn't even have a hard drive. So if you want that at $770, and who's going to buy that? They're soaking the fanboy. So sure, the guy who has to have that is going to buy it, just like you went out and bought a 3D TV 10 years ago. The problem is if there's no content that really justifies the purchase, ultimately this thing's going to die on the vine. I think publishers are unlikely to embrace the PS5 Pro. I think the market's going to be very small, maybe 10, 20 million units overall. And I don't think you're going to get any games, many games that really justify a giant purchase like that.
Your thoughts on two names as well, Michael. I want to get those for viewers. EA, Take-Two, you got buys on both. Specifically, let's drill down into Take-Two, though. Why is that a buy here?
Take-Two really got big in the mobile game business by buying Zynga, so they're pretty successful. And then since they purchased the Zynga assets, Zynga's launched a game called Match Factory that's on its way to being a $500 million annual title, really crushing it there. They're big in-app advertising, which is a big growth business. And then they have the biggest franchise in gaming history with Grand Theft Auto coming out next year. So you just got a lot of momentum from a company with a relatively small market cap. I think it's heading to 30, 40, 50% higher in the next year.
Do they integrate features of GT6 into the online offering, Michael? And when do you think that happens?
Yeah, I think that's kind of the worst kept secret on the planet. When they launched GTA 5 back in 2013, they launched GTA Online around the same time, but the games were built separately. This time, GTA Online has been in existence for over 10 years, 12 by the time they launched GTA 6. So I think that they've been incorporating features of GTA 6 into GTA Online for the last several years. And I think they'll unlock content for one in the other, which is going to just drive a lot of synergy between the two games. I think ultimately that means GTA Online revenues double from about 400 million a year to about 800 million a year just by managing the two assets together. So very, very thoughtful question. And I think that drives a lot of revenue and profit growth at Take-Two.
Michael, always love seeing you, brother. Thanks for being on the show.
Josh.
Coming up, McDonald's extends its popular $5 value meal. We've got the scoop on how long you can snag this offer and what's on the menu. Stay tuned. Mortgage rates may be coming down, but that doesn't mean housing is getting more affordable. That's the subject of today's chart of the day. Yahoo Finance's Julie Hyman joins me now with a closer look. Julie.
Yeah, even though, as we reported earlier, Freddie Mac showed that 30-year fixed income mortgages, that the rate had gone down to 6.2%. So directionally going in the correct direction at the lowest level since February of 2023. But a lot goes into buying a house, of course. It's not just about the rate, it's about the price. It's whether you can actually find the house. And the Atlanta Fed has an index that they have put together that measures overall housing affordability. That level still down at around its lowest since 2006. So still kind of muddling along there at those levels. And what goes into this index? I was looking into their definition here. They say it measures the ability of a median income household to absorb the annual costs associated with owning a median-priced home. And if you look at, as of the second quarter, Federal Reserve data showed the median price, and there are different measures of this, but their measure was around $412,000 for the median home price in the United States. Median incomes, by the way, as of 2023, just over $80,000, $80,600. So there are other factors that go into it, but that's sort of the number writ large. Earlier, we had the chance to talk to Danielle Hale about the idea of housing affordability and whether things are getting better. Here's what she told us.
I do think the rate picture is going to improve. Prices on the asking side of the ledger have been relatively stable over the last year, but sales prices have continued to move up as we see more expensive homes selling and less expensive homes kind of taking longer to sell in this market environment than we've seen traditionally. So there's a bit of shift going on in what's selling. And that does reflect the challenges that buyers of more affordably priced homes are facing.
And the other element that she talked about, which of course we're watching very closely, Josh, is what's happening in the labor market, which is slowing but not deteriorating notably, at least not yet. But that obviously plays a big factor in whether people can afford to buy a home.
All right, thank you, Julie. Meanwhile, McDonald's $5 value meal is sticking around for a little longer. The fast food chain extending the offer through December in most U.S. markets, and Yahoo Finance's Brooke DePalma joins us with more. What can you tell us, Brooke?
Josh, I know you're a big McDonald's fan. This is the news you need to know.
I was asked you off camera, what am I getting for the $5?
But the summer of value is now extending into the fall here, and McDonald's is keeping along with that $5 meal deal bundle that includes your McDouble or McChicken, fries, soda, and four-piece chicken nugget. That's right,
okay,
McNuggets.
that's what I wanted to hear.
So basically what they learned is that this average check that includes a meal deal is over $10 for their $5 meal deal. So consumers are adding more when they get this meal deal option. And this was really all an effort for McDonald's to change the way that consumers think about the pricing of how much McDonald's costs. Joe Erlinger, president of McDonald's USA, saying in the release that they're committed to keeping our prices as affordable as possible, which is why they're doubling down even more with ways to save. They'll also have more in-app offerings similar to what they've had previously. But this is all in place until a national value menu rolls out. So this will be extended to December. Many expect them to roll out a national value menu platform in early 2025. And we do know that McDonald's is still evaluating and planning that with franchisees right now.
I'm sold. I'm in.
You're all in.
That's all I had to hear. That's all I had to hear. It is interesting to think about, the balancing act here, because you want to bring in store traffic, but also impact to margins.
Right.
Go ahead. Sorry, I cut you off.
You have to think about how it impacts New York City restaurant versus, say, somewhere else.
For sure. Switching gears a bit, store design also in play. We're rolling out these self-serve cash kiosks.
Yeah, we know that McDonald's has been a big investor in digital concepts, and so they're rolling out this new store format that will have both cash and credit kiosks, so accepts both, different from what we've seen before. Now, this is less than 2% of U.S. McDonald's franchisees testing out this concept. They'll have no full menu boards behind the counter, but rather will promote sort of these value meals or other in-app offerings that they have. But guests can still order at the counter, or rather with a employee there. They'll have printed out menus, since there won't be those menus behind a counter. But there's no full rollout plans here. But keep in mind, this is something that McDonald's will roll out in future restaurant designs. But I know for a fact that I go to my local McDonald's, I'm more enticed to order at the kiosk. We know last October, they said that roughly 40% of their total sales are digital. So that includes app, delivery, and kiosks. So this is really moving forward with the times, so to say. Customers are going to the kiosk. They don't really want to talk to that employee behind the counter and say, hey, can I have that extra fries? Maybe as much as they used to.
Most of your stories, Brooke, I'm always hungry at the end.
Oh, God, me too.
That's the thing. The next time we do the story, it's at a McDonald's, because that's the thing that makes it. Thank you, Brooke. Appreciate it. Moving on, let's take a look at what's trending after hours. Shares of Adobe, they are sliding after fourth quarter revenue guidance missed expectations. That disappointing guidance overshadowing strong third quarter results. Revenue for the most recent quarter rising 11% from a year ago. Meanwhile, Oracle shares, they're moving higher after offering an optimistic outlook. The company is saying annual revenue will rise to at least $104 billion in fiscal year 2029. Oracle also lifting its sales outlook for fiscal year 2026, topping Wall Street's expectations. Shares of RH, they're surging after hours. The home furnishings company beating analyst estimates on the top and bottom line for the second quarter. The company also cutting its full year adjusted operating margin forecast. That's a wrap on today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all the latest market moving stories affecting your wallet. Have a great night.